Semiconductor giant ASML is already up 18% early in 2024. So is the stock still a buy for the rest of the year? That's what I'm going to look at in this video. In fact, the stock price is up so much that some investors think that ASML could do a stock split. So with all those things being said, let's take a look at ASML, its prospects over the near term and long term, and answer if the stock is a buy for 2024 and beyond.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
As I mentioned, ASML stock is up 18% year to date already. However, some semiconductor stocks are up much more than that, driven by the rising demand caused by artificial intelligence. ASML, of course, holds a dominant position, a near monopoly in its market, as it supplies high end technology to companies like Taiwan Semiconductor, Samsung, and Intel. They all need its technology to produce their own chips. And so ASML has excellent prospects going forward. And given its dominant position, it can exercise its pricing power in its industry that it operates. And you can see that when I show you its revenue for the trailing 12-month period. You can see it rising from less than 8 billion in 2016 all the way up to 29.83 billion in the most recent trailing 12-month period. Now 2024 is expected to be a slower year for ASML because of the export restrictions placed on it from sales to China of its high-end lithography machines. It can still sell its low-end lithography machines to China, but not the lower end. That represents a smaller portion of its business, around 10 to 15% of its business overall. Still, it's expected to slow growth for ASML in 2024. In fact, if we take a closer look at Wall Street estimates for ASML, they expect revenue to be flat in 2024, growing just 0.2%, with earnings per share falling by 3.9% in 2024. However, Wall Street expects its prospects to improve considerably in 2025, with revenue growth of 24% and earnings per share growth of 44% in 2025. 2026, again, double-digit revenue growth, 11.7% expected, with 20.8% earnings per share growth expected for ASML. So 2024 is going to be a one-off year where slow revenue growth is going to lead to some earnings per share decline, but the company's revenue and profitability is likely to increase meaningfully for the next several years beyond that. And the company's a healthy profit margin business. It demonstrates economies in scale, and you can see its operating profit margin has risen to 32.81% in the most recent trailing 12-month period. That was up from around 19% in 2015. That's a nice increase in operating profitability. Management thinks its profit margins are trending upward for the next several years as they continue to exercise pricing power and expand their profitability over the next several years. Further, if you look at its cash flow from operations to sales, it was also doing a very nice job increasing this metric up over 60% in the most recent trailing 12-month period before falling all the way down to 19.75% as the company invests in inventory to build up sales going forward, and as sales to China slow down in 2023 and going into 2024 due to the export restrictions. Finally, if you're looking at a stock that's trading at a reasonable valuation, ASML is certainly that. It's not cheap, trading at a forward price to earnings of 29.75, although it's also not expensive. It's trading at about its midpoint of its historical valuation according to this metric. You can see going back to 2020, investors have had some opportunity to buy this stock at a lower valuation, and there's been times when this stock is trading at a forward PE closer to 60. So at a forward PE of 29.75, it's a reasonable valuation here for this stock. But let's take a look at why the price to earnings ratio is an important metric. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. Okay, so now that you understand why price to earnings is an important metric to consider when looking at valuation and not just market price, you can understand that ASML is trading at a reasonable price. One thing I like to look at is the forward price to earnings ratio and the year ahead earnings per share expectations. So I showed you the year ahead earnings per share expectations is flat, negative 3.9%. Even for 2024, but then 2025 at 44% and 2026 at 21%. So a mixed story here. If you're looking at the year ahead, its earnings per share is not looking great. It's going negative, but then the year after that, 45% earnings per share expected for ASML, and then another nice increase the year after that. Okay, so earlier in the video, I also talked about stock split, and the stock is rising to levels where a split could certainly be in the cards for ASML. You look at the actual stock price, not just a gain, it's at $896 per share. So a stock split could be very well in the cards for ASML. However, I caution investors and I say a stock split or a pending stock split is not a reason to buy the stock. It's not, for me, it's not a reason to buy the stock. All it does is take an existing share of a stock and splits it into smaller pieces. It's no different than taking a slice of pizza and cutting it into two slices, taking one slice and cutting it into two slices. You're still getting the same amount of pizza, it's just split into two shares instead of one. Now, are you getting any more pizza? No, you're still getting the same amount of pizza. So why should you be willing to pay a higher price for cutting the pizza into another slice, right? It's a similar thing with stocks. You take a share of stock and you split it into 2 or 3 or 4, you're still getting the same amount of value. You're still getting the same amount of earnings. You're not getting anything more. So why should you be willing to pay a higher price? All right. Now, I know there's a lot of enthusiasm, a lot of headlines, and a lot of hype that goes around stock splits, but it's no reason to buy or sell a stock when a stock does a stock split. I often caution investors to that fact because it makes the case that, oh, now the stock is more affordable and more people can buy the stock. Well, you know, nowadays brokerages offer fractional purchases, so you can buy fractional shares of stock. So if you wanted to buy $100 worth of ASML stock, most brokerages will let you buy $100 worth of ASML stock. You'll get a fractional share. So if you wanted to spend $100, you can still spend only $100. So the stock split theoretically doesn't really make it more affordable to invest in ASML stock. So for all those reasons, I don't think a stock split is any reason to invest in a stock or not invest in a stock. With all that being said, At a forward price to earnings ratio of 29.7, and given its prospects going forward, I still think ASML stock is a buy, even though it's already up 19% in 2024. I still think the stock is a buy going forward. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.